Good afternoon, dear traders. Today we continue to study the topic of correlations. And if last time it was more about stock indexes and it is presented in your platform by CFD on stock indexes, today it is closer to currency instruments. So, first of all, it is worth highlighting commodity currencies. It is also worth noting that some currencies are sometimes called safe haven currencies, like Japanese yen, Swiss franc, or US dollar. Commodity currencies are the currencies of countries whose exports depends primarily on a particular type of raw material. According to the International Monetary Fund, the share of raw materials in such countries exceeds 50%. But even a smaller share can significantly affect the situation in the country and accordingly fill the budget. This usually applies to developing countries. For example, the share of raw materials in Burundi, 97%, Madagascar, 90%, Zambia, 88%. But even in developed countries, the share of raw materials in exports can be significant. This is Australia by 54%, Iceland by 56%, and another examples such as Canada, New Zealand, Brazil, Norway. Therefore, as soon as we meet these currencies in our trading platform, we say that they are commodity currencies. Let's start with the oil market, as it affects the currencies of most countries such as Canada, Russia, Norway, etc. First of all, you need to understand that the factor of correlation with raw materials is an auxiliary, not the main tool. That is, if we are talking about a pair of US dollar to Canadian dollar, then it affects the price of both raw materials and the strength of or weakness of the American currency as a safe haven currency, or inflation influences and possible actions in the future of the regulator. But what is important is that the commodity advantage can become a strength for the commodity currency against other currencies at cross rates. This is especially important when the dollar strength in all fronts. So, let's look first picture here. We look at the oil chart and see a powerful rally from multi-year lows and particularly no pullbacks. This is due to both monetary incentives and the still operating business cycle and trade expectations of inflation development. In this case, almost all types of raw materials get an advantage. It is important that we have already noted earlier at webinars, the market lays down expectations. The market lays down future scenarios. Current news is usually included in the price if something out of the ordinary does not come out. For those who did not manage to navigate the bottoms when oil priced almost like water, there was a great moment in the area of consolidation at 35. You see it. With the final false breakout. As a confirmation that sales are buying back. Now we open the chart of the US dollar against the Canadian dollar, and we see that the correlation is extremely high. That is, Just the peak of the fall in oil coincides with the peak of the weakening of the Canadian dollar. Then, following the growth of oil, there is a full return of the price to the levels of 2018. You see, oil loss and oil strength. Picture 4. Note that the breakdown of the 113 level in November 2020 130, you see it. 130, holding, and breakdown. Coincides with the breakdown of oil at the key level at 43.30. You see, the same date. Break up, break down. US dollar against Canadian dollar and oil. We see a similar but already weaker analogy for the Norwegian krone, where the share of oil in the economy also occupies a significant part. There is also a return after a panic peak and then a breakdown of 8.72, but with much less strength. Here already partly territorial, belonging to a more vulnerable Europe against the backdrop of a pandemic than Canada, which has a trading partner with the United States. But the influence of oil is also present. Here you see breakdown of 8.72. Holding, and with the oil prices break. Take a look at the date. It's all the same date and the same correlation, but some pairs with more correlation, some with less. Okay. Here the Russian ruble. And the Russian ruble, where the influence of oil on the budget feeling is very high. However, the geopolitical issue of recent years, sanction risks, and the developing structure of the economy have made the Russian ruble much more vulnerable. In this case, countries that are often experiencing difficulties are forced to weaken their currencies in order to support the export component. By the way, an almost uncontrollable jump from 30 to 85.92 was just associated with the oil price collapse in 2014. Let's look. And oil prices. But we see that almost 50% recovery in oil did not lead to a strengthening of the ruble, say in the area of 60-65, similar in pace of movement, which indicates the weaknesses of the currency and inherent risks of expectations. Recovering of the oil prices, almost 50% from this peak of 100, and Russian ruble near 30 and now 73, not 65 or 60. Okay. The Australian dollar has a lot to do with the production and sale of gold. On the chart, we can see that the correlation is no longer as tight as the oil commodity currencies. But nevertheless, from March 2020, this correlation recovered until the end of 2020. Here, gold prices. Here, Australian dollar against US dollar. While gold rising, Australian dollar weakening, and then correlation recovered. Here and here. This again suggests that correlations can be broken and reappear. And this is not a panacea, but a complementary factor. Moreover, the violation of correlations may promise good trading opportunities on weakening commodities, but on a retreating currency and vice versa. For example, here was the strength of gold at the breakdown of 1,359, but the weakness of the Australian dollar, and further retreating gold from the 1,911 historic peak, and the strength of Australian dollar above 0.75. I marked all these prices. Few peaks of gold and strength of Australian dollar. In part, these may again be related to the inherent expectations of a renewed interest in gold after a correlation of the expectations of inflation. We just looked at the Canadian dollar, talked about the Norwegian krone and its correlation with the European economy and the euro. About oil and commodity currencies, we also talked. Now we come to the conclusion that you may have a very important, essential question. How can you measure this correlation in currency instruments in numbers? There are many resources that allow you to evaluate this correlation over different time periods. I use this. Let's analyze gold and look at correlations over the past 300 days. Gold, time frame daily, number of periods. You can choose another numbers, daily, weekly, or for example, hourly, number of periods, 20 days, etc. And after calculate. We can see that the Australian dollar has a correlation, but it's only 0.66. The closer to 1, the greater the correlation. Silver, on the other hand, is trading with a high correlation of 0.83. That is gold and strength of correlation. But with the European currency, there are much more significant correlations over the past 300 days, as well as the New Zealand dollar. Take a look. 0.93, 0.91. Very high correlation. you can see also charts. Now, the answer to the question why we often look at the strength of or weaknesses of the dollar through the prism of the relationship between the dollar and the yen as a safe haven currency. We see another safe haven, the franc, with a very high correlation of 0.88, and the euro against the dollar with an inverse correlation of minus 0.82. That is, minus indicates an inverse correlation, or minus 1, this is a complete reverse correlation. At the same time, we see that due to the additional factor of oil, the correlation with the dollar to the Canadian dollar is small. So, it has its own ideological trait. US dollar against yen daily, 300 days, almost a year. US dollar against Swiss franc with a high correlation. Then euro dollar inverse correlation. So you can see, you can choose and analyze pairs with high correlations, with low correlations, and so on. So, evaluating correlations, understanding their essence, and this assessment should be carried out not only with an analysis of 300 days, as I said, but for the last weeks, for the last days, and so on. Such an assessment will allow you to evaluate the tools much more deeply and find interesting potential ideas. I hope that today we have completed and consolidated the topic of correlations. At the next webinar, we will come to the topic of fundamental analysis, the impact of which we analyze in almost every webinar. I wish you professionalism. I hope that this lesson was useful for you, and see you soon.